Thank you, Emma. Good morning, ladies and gentlemen. I'm very pleased to be here to present our latest State of Transition report. In my speaking instructions for today, Adam said to me, "I want the full Dietz," to which I replied, "Well, I was planning to wear a suit." And luckily for you, I decided to do that. Now, a lot of people and institutions stand behind this report, but let me just begin by acknowledging a few people who've made a particular contribution. First of all, my co-authors on the report. So from the LSE team, Rhoda Byrne, Dan Gardner, Valentine Jahn, Michal Nachmani, Yolene Knowles, and Rory Sullivan. From our FTSE Russell colleagues, Yako Kuroshi, Sarah Williams, and Ed Bourne have been really helpful in providing us with the data and providing support in the interpretation of that. And lastly, for their editorial contributions, Adam Matthews, Faith Ward, and Nadine Veal-Lamar. So let me start by just saying a few words about the initiative, which I think will be familiar to most of you, but it's always good to start to talk about TPI by describing the initiative. So we are a global initiative led by asset owners and supported by asset managers. We started in January 2017, whereupon, looking back yesterday, I think we had 18 supporters, accounting for about $2.5 trillion of assets under management. By January 2018, we had 27 supporters, accounting for about $6.25 trillion of assets under management. And today we have something around about 50 supporters, accounting for more than $14 trillion of assets under management and advice. So it's been great to see the initiative grow so much. Our fundamental purpose is to assess the progress that large public corporations are making on the transition to a low-carbon economy. We do that in line with the recommendations of the FSB Task Force on Climate-Related Financial Disclosures. So one of the things we can do is essentially monitor the performance of corporations against the TCFD recommendations, and I'll be showing you some data on that later on. We're also very pleased to be providing data into the Climate Action 100+ engagement initiative alongside a series of other data providers. TPI is, I usually describe it, a public good. All of our data are online and open access on the TPI website. We currently cover 274 companies in 14 sectors of the economy. And now, working out what share of global emissions from public listed companies this amounts to is a bit of a hairy business. But our best guess is that it's about 41% of emissions from public listed companies globally. Here, again, are the main partners of TPI. So we come from the Grantham Research Institute, which is a research centre of the London School of Economics. We're the academic partner. That means we perform the company assessments, design the methodology, and also host the website and the online tool. We're supported in this by FTSE Russell, who are our data partner, and they provide us with a subset of their ESG ratings data, which we use to assess what we call management quality. And we're also supported by Principles for Responsible Investment, who provide a secretariat for the initiative. And underpinning all of that, of course, is a group of asset owners and managers. And here they are, or at least here they were a few weeks ago, and we've had some new joiners since then. And very lastly, before I get into the report, I'd like to particularly acknowledge the support of our research funding partners, Aberdeen Standard Investments, BNP Paribas Asset Management, Legal and General Investment Management, and Robeco. They have provided strong support for the publication of this report. Okay, so now I can get on to explaining how we assess the progress of corporations on the transition to a low-carbon economy, which is, I think, is an essential underpinning to actually interpreting the data that I'll show you a little later. We assess companies in two ways. The first way we call management quality, which is essentially an assessment of companies' governance or management of climate change as an issue, and the opportunities and risks that it constitutes for the company in question. The other way we look at companies is quite different. We call it carbon performance, and this is a quantitative assessment of companies' carbon footprints, essentially, their emissions intensities, and whether now or in the future these companies could be said to be aligned with the objectives of the Paris Agreement on climate change. So it's a benchmarking exercise in a sense. And for the database, we select the largest companies by market value in the highest emitting sectors. So of the 274 companies that I'll be presenting data on today, we have 116 energy companies, specifically belonging to the coal mining, electricity, and oil and gas sectors. We'll be showing you data on 102 manufacturing and basic materials companies, and these are in sectors such as aluminium, cement, paper, and steel. We currently include 41, if you want to call them, transportation companies in 2 sectors, automobile manufacturers and airlines. And lastly, we cover the largest companies in the otherwise usually not high-emitting consumer goods and services sector. What you can see on the right of this slide is a screen capture of the online tool. So, never mind the laser. You can see it roughly in the middle of the slide. You can see companies in the airline sector laid out on our management quality staircase. And then at the bottom of the slide, you can see transition pathways for each of these airlines as set against the Paris Agreement benchmarks. Just a flavour of what you can see on the tool. Now, in putting together the data, we've followed several design principles. The first and perhaps most important one is that our assessments are based on disclosure. They're based on publicly available information provided by the companies themselves. And there are, I think, 2 fundamental reasons for that. The first is that disclosure is a core part of TPI's philosophy. It's important that companies disclose information to their investors. And so we want our framework to essentially incentivize that. And secondly, having our analysis based on publicly available information allows us to treat companies consistently and avoid as far as possible analyst subjectivity. Secondly, we're trying to be useful. I always make the joke at this point that this is an unusual goal for an academic to have. But we're trying to be useful, and in particular, we're trying to provide a tool which is easy to access and understand. So it would be particularly useful for investors with relatively limited time to put into the issue of climate change. Thirdly, we're not trying to reinvent the wheel. So we're trying to make best use of existing initiatives and disclosure frameworks such as TCFD and CDP. We are trying to use data that are commonly requested by investors. We are trying not to unnecessarily add to the burden of company reporting on climate change. And lastly, our data is pitched at a high level of aggregation, at the level of the whole corporation, which means that for some purposes, for instance, the evaluation of specific green bonds, investors would want to dig deeper. But we want to look at the whole corporation. Now, the management quality framework sorts companies onto 5 steps of the staircase, if you like, ranging from companies who are, on the basis of their disclosures, seemingly unaware of climate change as an issue, all the way up to companies which we describe as being strategically assessing climate change. And we do this based on up to 17 individual indicators. You could think of these as governance or management practices. So the question is, does a company implement this particular practice? And the data for these come from FTSE Russell, from their ESG ratings data, and we organize them into this framework. So the sorts of things you can see here include very basic questions about whether companies have a policy on climate change, whether they explicitly recognize that climate change is a risk or opportunity for the business. Moving through more operational steps, such as companies monitoring and disclosing their greenhouse gas emissions and setting some form of target which would reduce their future emissions, all the way up to the really advanced steps, such as companies applying and disclosing their internal carbon price, conducting scenario planning as foreseen by, for instance, TCFD, and integrating climate risks and opportunities in strategy. We're adding questions to the framework as we go along. The data I'm presenting to you today is based on these 17 indicators. By the end of the summer, we'll have another 2 indicators related to companies' climate lobbying activities. Now, our carbon performance assessment requires a little bit more explanation in my experience, so bear with me for a few minutes. The exam question here, and of course I do like setting exam questions, not necessarily marking the consequences, is a company aligned with the Paris Agreement goals? And we do this by taking the same approach as the Science Based Targets Initiative, so an approach called the Sectoral Decarbonisation Approach, which was created by CDP, WWF and WRI in 2015. Basic idea here is you measure a company's carbon emissions intensity, and then you compare it with a benchmark emissions intensity, which corresponds with the different goals of the Paris Agreement. In most sectors, the 3 benchmarks are firstly what we call the Paris Pledges, in other words, a benchmark corresponding to countries' nationally determined contributions to the Paris Agreement, which, as I think all of you know, are not currently putting us on a path to limiting global warming to 2 degrees above pre-industrial. Secondly, a 2 degrees benchmark corresponding with the overall goal of the Paris Agreement. And thirdly, a below 2 degrees benchmark, which is a more ambitious interpretation of the Paris Agreement language around well below 2 degrees and aiming for 1.5 degrees. Now, what is very important is that the benchmarking is sector specific, because whichever model you look at, reaching the Paris Agreement goals in a cost-effective manner means different sectors moving at different speeds. And the benchmarking exercise needs to reflect that. So it doesn't require all companies in all sectors to cut their emissions at the same rate. That would be unrealistic. That makes it harder, but it's an essential part of the process. I also thought I'd use this moment this opportunity to make a few comments about the merits of using intensity measures versus absolute emissions reductions, because this often comes up, and it came up a little bit on Twitter this week as well. Now, working with intensities is important, because otherwise you can't compare companies of very different sizes. You need to normalise somehow, whether it be revenue or megawatt hours of electricity or tons of steel. In order to make a meaningful comparison, you need to normalise. But of course the concern is that once you normalise by a measure of companies' activity, you're vulnerable to the fact that that activity might grow so fast that companies' emissions reductions are not enough to keep within a carbon budget. But if this process is followed carefully, you can ensure that the carbon budget is adhered to. That was the idea behind the sectoral decarbonisation approach. So you start with the science. The science defines the carbon budget. You then look to the models to tell you how the carbon budget is apportioned to different sectors of the economy, like electricity, manufacturing, transportation. You look to the same modelling to tell you what level of activity, say production, is associated with that sectoral budget. And then those 2 pieces of information, the sectoral carbon budget and the associated sectoral economic activity, gives you your intensity benchmark. So you can see that it starts with the overall economy-wide carbon budget, and there is therefore no reason why an intensity-based approach cannot be consistent with staying within a carbon budget. The aim is to get all companies below the benchmarks as soon as possible. As long as all companies in a sector are below the benchmarks, then the benchmark is adhered to at the sectoral level. As long as the sectoral projections are consistent with where the world is heading, then the whole thing works out. In most sectors, the data we use for the benchmarking comes from the International Energy Agency. There are exceptions. For example, in transportation, we use the International Council on Clean Transportation model. The typical output from an analysis like this you can see on the right-hand side of the slide. The 3 benchmarks are in different shades of blue. The intensity that you could think of, say this is electricity, the intensity measure would be tons of CO2 per megawatt hour of electricity generation. If it were, say, autos, it would be grams of CO2 per passenger kilometre of the company's fleet of new vehicles. For each company, for past years, we have real historical disclosed emissions data. To project it forward, we look at what emissions reduction targets companies have set, and we make our projection on that basis. So the forward-looking part is target-driven. The backward-looking part is real disclosed data. And this is how we test the alignment of companies with the Paris goals. Okay, I can start my talk now. Thanks for bearing with me. So, State of Transition 2019. 274 companies, 14 sectors of the economy, 41% of emissions from global public companies, plus or minus. Let's start with management quality. There's good news and bad news. We'll start with the good news. The good news is that only 9 companies are assessed by us as being unaware of climate change. And for several of these companies, there is evidence that they'll move off the bottom step of the staircase this year because of improved disclosure. Actually, quite often a reason for being on level 0 is not that the company is completely unaware of the issue. That would be quite difficult in this day and age. It's that they just don't provide investors with any information about how they're thinking about it. So it's not the hardest thing in the world to address, and we expect some of these 9 companies to do that this year. More than half of companies are now on our levels 3 and 4, which is also a piece of good news. 71 companies can be said to have integrated climate change into operational decision-making. 77 companies have reached a level of strategic assessment. The average company is somewhere between levels 2 and 3. So if we treat level as a continuous variable and just calculate the average, then the average is about 2.5, which is the basis for me saying they're about halfway between levels 2 and 3. That's the good news. The bad news, though, is that nearly half of the world's largest emitting companies are not yet on level 3. And concretely, let me say what that means. It means that almost half of companies don't do one of the following things. They haven't explicitly recognised climate change as a relevant business risk or opportunity. They don't have a policy commitment to act on climate change. They don't disclose their operational greenhouse gas emissions, or they don't have a target, even a qualitative target, to reduce their greenhouse gas emissions in the future. That is 126 companies that haven't implemented at least one of those steps. Within that, of particular concern for investors, I think, is the fact that 26% of these companies do not disclose their emissions. Ergo, we have no real idea what their carbon footprint is, or whether they could be aligned with the Paris Agreement or not. We can have a little look at how the management quality data break down by sector. Now, the best performing sector is actually consumer goods and services, but it's important that you don't overinterpret that data because we only have 15 companies in the consumer goods and services sector, and because of the selection criteria, these are the largest companies in that sector by and large. And in other research we've done in the past, we have found a statistically significant size effect on the quality of companies' disclosures. Companies with large market cap, all else being equal, provide better disclosure. So I wouldn't overinterpret that. Bigger sectors, in terms of sectors where we cover more companies which perform well, include particularly electricity, with an average management quality score of 2.9, so basically roughly bang on level 3, and automobile manufacturers with an average score of 2.5. The worst performing sector in TPI at the moment is steel. Steel is the only sector which has an average management quality score which is under 2, fractionally under 2. And in fact, of the 5 worst performing sectors, 4 are manufacturing sectors, the other 3 being paper, cement and aluminium. So one of the findings coming out of our management quality assessment by sector is that the manufacturing sector seems to be lagging behind other high-emitting sectors in its climate change disclosures and in its climate change management and governance. Things that manufacturing companies seem to be particularly weak at include explicit acknowledgement of climate change as a business risk and opportunity in their disclosures, board oversight of climate change issues, and incorporation of ESG issues in executive remuneration. Now, for companies who satisfy all 16 or 17 of our management quality criteria, we have a star. So we give such companies a gold star. And we currently have 8 companies that can be said to be 4-star companies, and they're all energy companies. AGL Energy, Anglo American, BHP Billiton, Centrica, Equinor, Gas Natural, National Grid, and Repsol. Now, these companies do all the basics, and in addition, all of these companies do all of the following. They have long-term quantified targets to reduce their greenhouse gas emissions, defined as at least 5 years in duration. We could split hairs about the definition of long-term, but that's how we define it at the moment. They all incorporate ESG issues in executive pay. They all incorporate climate change risks and opportunities in company strategy. They all undertake and disclose climate scenario planning, and they all undertake and disclose an internal carbon price. So as far as management quality is concerned, these companies are currently our stars. Another thing we can do with the management quality data is we can break it down into these 17 individual indicators, and that's what I do on this slide. And in addition to that, we can organise the indicators in a different way. We can organise them according to the TCFD recommendation areas, which enables me to say something about the progress of these companies against the TCFD recommendations. So this is a somewhat complicated slide, and therefore let me just take a moment to talk you through what you should be looking at here. Down the vertical axis, you have our different management quality criteria, management practices, if you like, organised in a different way by TCFD recommendation area. Across the horizontal, you have the proportion of companies satisfying that criterion. And you can see the colour coding corresponds with the TCFD's 4 recommendation areas, namely governance, strategy, risk management, and metrics and targets. So what do we see? Well, we see that companies are relatively strong in the governance area, particularly in taking the basic steps, like having a climate change policy and providing explicit recognition of climate change as a business risk or opportunity. Fewer companies, but still slightly more than half, have apportioned board responsibility for climate change and have incorporated ESG in executive remuneration. Companies are somewhat less strong, but still relatively strong on metrics and targets, particularly on disclosing direct and indirect greenhouse gas emissions, and also on having set some form of emissions reduction target. Less strong on some of the more demanding indicators under metrics and targets. For example, only 41% of companies for whom emissions downstream in the value chain from use of sold products are important actually disclose those. So these are companies are, for instance, oil and gas producers, coal miners, and automobile manufacturers, I think. So still only 41% of companies disclose that important category of so-called Scope 3 emissions. Next is risk management. So of our 2 measures to assess companies' risk management of climate change as a risk, about 2/3 of companies have a process to manage climate risks, but only 1/3 of companies incorporate climate risks and opportunities in strategy. But the one TCFD area where companies appear to be particularly weak, perhaps unsurprisingly, is strategy. Although slightly over 50% of companies are supportive of domestic and international actions to reduce, to mitigate climate change, well under 1/5 of companies disclose climate scenario planning or have an internal carbon price. So of the TCFD recommendation areas, our view is that strategy is currently the one on which companies are most wanting. Now, we've been going for 3 years and we now have trend data on management quality. We've been growing our database, so we have trend data on 130 of the 274 companies. That is, we collected data on them in 2017 and in 2018. And of the 130 companies, we found that 82 have stayed on the same level over these 2 years. 35 companies have moved up at least one level, and 13 companies have fallen at least one level. Of the 82 companies that have stayed on the same level, of course, 25 of them are on level 4, so strictly speaking, they can't move up. But on the other hand, they could get a star, and only 2 companies managed to do that from 2017 to 2018. The most commonly observed move is up from level 1 to level 2 or level 3. So 9 companies moved from level 1 to level 2, and 4 companies moved from level 1 all the way up to level 3. And mostly this was achieved simply by providing explicit recognition of climate change as a risk or opportunity for the business. Oil and gas producers were particularly apt to make progress over the 2 years that we've got data. And most of those moves in the oil and gas sector were from level 1 to level 2 or level 3. And lastly, just to call out 2 companies which made a big jump from level 1 to level 3. The 2 examples we provide in the report are the car maker Subaru and the electricity utility First Energy. Now on to carbon performance. Now you're used to us showing you this as a traffic lights table or as pathways. But for the Climate Action 100 Plus initiative, we had to collapse this into a single indicator of alignment. And I quite like what we did there, I dare say, so that's what I'm going to show you today. So the idea here is we compare a company's last data point with the benchmark in 2030. So the easiest example here is a company that has an emissions target for 2030 or perhaps even beyond. Then this is a simple comparison of where it would be in 2030 with the benchmark in 2030. But where we have companies that don't have a 2030 target, maybe they have no target, we compare where they get to in the last year for which we have data with the 2030 benchmark. So for instance, most obviously, if a company is already under the 2030 benchmark, then we say it is aligned. And clearly that's predicated on the assumption that its carbon intensity doesn't go back up again. But that doesn't happen a lot. So I think it's a reasonable assumption. And in other parts of the report, we test that assumption, in a sense, or relax that assumption, by only looking at companies with 2030 data. But the data I'm going to show you now are based on this basic idea. If you've already got to where you need to be in 2030, we assume you're aligned. If you have a target which gets you there, we call you aligned as well. And here is our assessment of alignment as it currently stands. This is for 160 of the 274 companies where we collect these data. 33 companies whom we can assess for carbon performance don't disclose what we need. In some cases, that's because they don't disclose anything. In some cases, it's because they don't disclose the right information for us. 79 companies, so that's almost half of the data set, do disclose but are not aligned. Either they're not aligned today or they won't be aligned in the future. 48 companies, which is a little over a quarter, are aligned with at least one of the Paris Agreement goals, at least with what we call the Paris Pledges. Within that 48, 26, or 20 plus 6 if you want to look at the pie chart, are aligned with 2 degrees, and of that 26, so you can see how this works hierarchically, I hope, 20 are aligned with below 2 degrees. So, 2 messages really coming out of this. Firstly, most companies are not aligned, certainly not aligned with 2 degrees or below. And secondly, only 20 companies are aligned with below 2 degrees, either now or by 2030. I can break that down for you by sector and show you a few things. Most of the below 2 degrees alignment comes in 2 sectors, electricity and paper. And now in electricity, one of the main reasons for that is that most of the below 2 degrees aligned electricity utilities are European utilities which are already heavily regulated under the EU emissions trading system, and we're comparing them with global benchmarks. So I wouldn't overinterpret that. The alignment in paper may be more genuine. The alignment in the steel sector often reflects the fact that there are 2 basic business models in steel, making steel out of iron ore in a blast furnace, Port Talbot style, or making steel out of scrap by using electric arc technology, which is very low carbon. So the aligned companies have a business model which works in a low carbon economy. I'd like to also make a couple of further observations. Firstly, on oil and gas. So at the moment, we only look at the top 10 oil and gas producers on carbon performance. That will go up to about 40 to 50 companies this summer. If we take 2030 as our cutoff point, no oil and gas company is aligned with the Paris Agreement goals. But if you've read our discussion paper, you know that if we roll that horizon out to 2050, on the basis that, well, oil and gas companies are existentially challenged on climate change and they may need more time to transition, then two companies, Shell and Total, become aligned at least with the Paris pledges, not with any of the other benchmarks. The last observation I'd want to make is to call out three companies who are aligned and for the right reasons, or sort of where alignment looks like it is or genuinely would be a significant achievement. So no prizes for guessing the car maker that's aligned with below 2 degrees, it's Tesla. The other two companies where I think alignment is interesting are the two cement makers. They're not aligned with below 2 degrees, but they are aligned with 2 degrees, which I think is an achievement because cement is one of these so-called hard to decarbonise sectors, and the two companies in question are Ambuja Cements and Lafarge Holcim. Now, I'm nearly finished, you'll be pleased to know perhaps. One of the last piece of significant analysis we do in this report is designed to help investors think about how they engage. So the last piece of analysis we do is we look at the association or correlation in our data between management quality and carbon performance. This is designed to address questions such as, if investors would engage companies on their management practices, would this actually deliver a result at the end of the day in terms of companies' carbon emissions? So we take the companies in our data set, particularly the 160 companies for which we have carbon performance data. We group them into aligned and not aligned. That cutoff is the Paris pledges. And for the aligned and non-aligned companies, we look at the share of management quality practices that they currently satisfy. So what you can see in the top right here is that for the aligned companies, they satisfy 2/3 of our 16 or 17 management quality criteria. If you look at the non-aligned companies, they satisfy only 49% of the management quality criteria. So there is an association. Companies that are better on management quality are better on carbon performance, according to our way of measuring carbon performance. And this difference is statistically significant, and it also survives controlling for company size, region of headquartering, and sector. We can do this same comparison for the 4 TCFD recommendation areas, so breaking up the indicator set into the 4 areas, and we find that in each of the 4 areas there is still this difference between aligned and non-aligned companies. Statistical power falls, of course, when the sample size falls, so the only sector for which this difference is statistically significant anymore, the only recommendation area is strategy. A tentative conclusion which would emerge from that is that strategy and management indicators which are designed to address strategy are possibly a leading indicator of companies' emissions performance. So let me summarize my talk. Most companies have built basic capacity to manage the low carbon transition. And yet too many big emitters are yet to integrate climate change into their operations, let alone to take a strategic approach. Within that, we're particularly concerned about significant disclosure gap on emissions. So as I said earlier, 26% of the 274 companies do not disclose their direct and indirect greenhouse gas emissions. And of the 160 companies we assess on carbon performance, 21% don't provide the right information. Few companies are aligned with the Paris Agreement goals in terms of their emissions intensity today or at any point up to 2030. But it is possible, on the other hand, to identify a small set of leaders that show what is possible, illustrating, for instance, business models which ensure alignment with the Paris Agreement, or even if they don't have a business model which ensures alignment today, they have a way through, a way to cut their emissions sufficiently to stay on track for Paris. And lastly, management quality and carbon performance are correlated, they're associated. So engaging particularly on strategic aspects of carbon management may help to deliver future emissions performance. Nonetheless, the association is far from perfect, so it is important that investors continue to engage directly on emissions targets. Thank you very much for listening.